Hello, good evening, everyone. In today's discussion, I would be talking about how do we analyze risk in investment decisions and what are the different involvements in evaluating them. Analyzing risk in investment decisions involves a systematic evaluation of potential uncertainties and their impact on expected outcomes. Here is few types of investment risks I can talk about. First one is market, which fluctuates in market prices or any different interest rates. Second one is the credit risk, which is by default published by the borrowers or different counterparties. The liquidity risk talks about selling assets without any significant loss, while operation risk is different failures in procedure systems or external events. Inflation risk can also be effective in purchasing power whenever inflation hits it. The different assessments in financial objectives is when we define investment goals, for example, income generation, growth, or capital interest, and how we determine the risk tolerance with high, medium, or low, and we quantify the risk based on its volatility, value at risk, scenario analysis, and stress. To go in bit deep of that, we use different metrics like standard deviation or beta to measure the price variability, and for value at risk, we estimate it with potential loss over a specific period for a given confidential level, whereas in scenario analysis evaluates outcomes under different market conditions like economic downturns, market rallies, etc. And the stress testing is also a good way to perform how extreme each scenario can go. For example, in a financial crisis, how does it impact your investments? So diversification is also used to reduce the risk by spreading a different investment across stocks, bonds, real estates, and not categorizing them into a single asset. It's always better to spread your investments in industries or sectors within other geographical regions as well. To analyze the historical performance, we review the historical data to understand all the past trends and cycles from the past experience or performances, which do not guarantee future results but provide a context. So, in these conducting the fundamental and technical analysis, we can include fundamental analysis, which will help us study about the financial health, valuation of business prospects in assets, and the technical analysis will help us in indicating the different patterns and price movements. We can also use different risk ratios to categorize them, and different leveraging different professional tools like Bloomberg Terminal, Morningstar, and risk management frameworks, which will help us monitor the microeconomic and sector specific trends. So the risk analysis uh, in investing is identifying different types of risk, which is understanding the various risks involved in the investing, which is the foundation of the analysis when we consider risk in it. And the first one is market, which is exploring the fluctuations in the stock market, interest rates due to inflation. An example can be stock market value dropping because of the market drop down. And the second one is credit risk. It is by default when you borrow money or from a counterparty. Um, uh, a good example can be a bond when failing to pay its interest or principal. Operational risk is due to internal failures such as processes breakdown, fraud, and different cybersecurity issues. Regulatory and political risks can be affected because of the changes in laws, regulations, political instability, um, can also very much impact these investments. And last but not the least, the inflation risk, which is the uh, eruption of the purchasing power due to rising of the prices. So, on assessing this impact risk on investment return, the investors must analyze how risk can influence these potential returns by trading off, like risk return trade off, which is higher, often come with the potential higher returns but not guaranteed. Because as an example, I can talk about some small caps stocks which are more volatile but may offer higher growth compared to the larger cap stocks. And expected value and variability can also be an influential potential return, which will evaluate the expected return and volatility around that return. There are also few downside risks, which focuses on the potential losses rather than an average return. And the correlations will understand how different investments interact and how they highly correlate assets may amplify the risk during the market downtowns. Um, there can be also different tools and techniques to measure and manage risk, like beta, value at risk, standard deviation, Sharpe ratio, which assesses risk adjusted returns. Higher is better. The scenario analysis and stress testing, which will help perform under adverse conditions like interest rate hikes, economic downtowns, and geopolitical crisis. Diversification is also one of the best way to measure and manage risk by spreading the investments across different classes of assets, industries, and geographical regions to reduce the concentrated risks. Um, so, by identifying all these risks and assessing their impacts and using appropriate tools to mitigate them, investors can make informed decisions that align with their risk tolerance and financial goals. Thank you.